What's up, guys? Welcome to the Cashcraft, your daily dose of finance and technology news and updates. When a crypto trader makes 400% on price action but can't explain what their tokens actually do, something's broken. For years, crypto has been a pure speculation game. Price goes up, you win. Price goes down, you lose. The fundamentals? They barely mattered. But right now, in March 2026, that entire playbook is being rewritten. The market's starting to ask a question. It's ignored for over a decade. What does this thing actually earn? This isn't just a philosophical shift. It's already changing where billions of dollars flow. And if you're still playing the old game, you're about to get left behind. Here's the setup. Traditional finance has always had a North Star. Yield. Bonds pay interest. Stocks pay dividends. Real estate generates rent. You can argue about valuations all day, but at the end of the quarter, there's a number. Cash flows in or it doesn't. Crypto never had that. Sure, Bitcoin maxis talked about digital gold and store of value, but gold doesn't pay you to hold it. Ethereum had staking, but the yields were inconsistent and the narrative kept shifting. Most tokens? Pure speculation on future adoption that might never come. For a long time, that was fine. When Bitcoin's climbing from $10,000 to $60,000, who cares about a 4% yield? Price action drowns out everything else. But here's what's happening now. Volatility is compressing. Bitcoin's trading in tighter ranges. Ethereum's not doing 10x moves anymore. The easy money from just holding and hoping, it's drying up. And when price stops doing the heavy lifting, investors start asking the uncomfortable question, what am I actually earning here? This is where it gets interesting. Crypto is finally building real fixed income infrastructure, not the DeFi Wild West of 2021, where 20% APY meant your tokens were being rehypothecated into oblivion. Actual, measurable, sustainable yield from protocol revenue. Ruchir Gupta at CoinDesk just laid this out. We're moving toward a true fixed income market for crypto-native yield. Protocols that generate fees from real usage. Staking rewards tied to actual network security work. Lending markets with transparent collateral and risk models. The numbers are starting to matter. When a Layer 2 network processes $500 million in transactions and kicks back fees to token holders, that's not speculation, that's revenue. When a DeFi protocol generates $12 million in monthly fees and distributes them to stakers, you can build a model around that. You can compare it to other assets. You can make an actual investment decision instead of just gambling on Elon's next tweet. And the institutional money, they've been waiting for exactly this. Pension funds and endowments can't pitch their boards on number go up narratives. They need yield curves. They need risk-adjusted returns. They need something that fits into a portfolio model built over decades. Crypto's finally giving them that language. But here's the thing most people are missing. This shift doesn't kill speculation. It just separates the wheat from the chaff. Tokens with real yield will start trading like bonds or dividend stocks, with valuations tied to cash flows. Tokens without yield, they'll still exist, but they'll be recognized for what they are. Pure beta plays on sentiment and narrative. The market's bifurcating right in front of us. What this really means is that crypto's growing up, not in a boring way, in a legitimate way. For 10 years, the knock against crypto was, it's just gambling. That critique's about to lose its teeth for a significant chunk of the market. When you can point to $50 million in quarterly protocol revenue backing a token's value, you're not gambling anymore, you're investing. The question you should be asking yourself is, which tokens in your portfolio actually generate yield, and which ones are just narrative plays? Because over the next 12 months, that distinction is going to determine who makes money and who's just along for the ride. Start looking at fee generation, staking returns, and protocol revenue the way you'd look at a company's earnings report. Personally, I'm shifting 30% of my crypto allocation toward high-yield protocols with proven fee generation. The 100x moonshot plays are still there, but I'm not betting the farm on them anymore. That's all for today, folks. If you found this helpful, make sure to like and subscribe to the Cashcraft for more finance and tech news. Drop a comment below with your thoughts, and I will see you in the next one.